Welcome back to The Explainer. Let's jump right in. Today we're unpacking an in-depth valuation of the Canadian energy producer Whitecap Resources, trading under the ticker WCP.TO. We're going to break down their financials, analyze their intrinsic value, and try to determine exactly where this stock sits in the current market cycle.
So we're playing financial detective today. And here's the central mystery we need to solve. Is Whitecap Resources a deep value energy compounder that deserves a spot in your portfolio? Or is it a late cycle trap just waiting to catch unsuspecting investors? The market is heavily divided on this, so we're going to strip away the sentiment and look strictly at what the underlying data actually proves.
Here is our roadmap to figure this out. We'll start with the upstream business model, move into financial strength and cash flow, test their moats and risks, calculate the intrinsic valuation, and wrap up with target prices and our verdict.
Section 1. The upstream business model.
Okay, so how does Whitecap actually make its money? Well, their model is completely straightforward. They're a classic upstream energy operator. They acquire reserves, drill wells, and produce light oil, natural gas liquids, and natural gas across Western Canada, which they then sell directly into North American energy markets. What makes this so highly attractive for value investors is its absolute simplicity. There's no wild tech innovation to bet on here. It relies on measurable reserves, known extraction costs, and globally traded commodities. But keep in mind, operating in Western Canada often means their assets trade at a discount to U.S. counterparts, so rigorous capital discipline is absolutely crucial to their profitability.
Their strategy leans heavily on what we call low-decline assets. Basically, their wells don't dry up nearly as fast as typical shale producers. They pair this with disciplined capital allocation, focusing heavily on returning value to shareholders through dividends and buybacks. But here's the kicker. They're also incredibly aggressive acquirers. In recent years, they've successfully doubled their assets and production through opportunistic acquisitions. Now, doubling production creates massive scale for sure, but it severely tests management's ability to keep lifting costs low across all these newly integrated assets. This whole strategy basically hinges on keeping those long-life reserves flowing efficiently to justify that expanded infrastructure.
Section 2. Financial strength and cash flow. Let's see the results. Now, here is the most important receipt of all. 1.17 billion Canadian dollars. That is Whitecap's trailing 12-month free cash flow. This figure is massive. Generating 1.17 billion in free cash flow is particularly impressive relative to their overall market cap, and it really underscores their deep value positioning. It just highlights the incredible cash generation capabilities of this business when commodity prices are supportive. This is the real, tangible cash left over after all the heavy lifting of capital expenditures, giving management the firepower they need to fund those dividends, buy back shares, and pay down debt. Zooming out to the broader balance sheet, their trailing 12-month EBITDA sits at a towering $3.33 billion against net debt of $3.01 billion. That puts their leverage right at about 1.1 times EBITDA. That is a very manageable ratio, and it provides a vital buffer against sudden commodity price shocks. However, there's a catch. To maintain that EBITDA, Whitecap has to pour roughly $2.35 billion annually into capital expenditures. The upstream business requires constant, heavy reinvestment just to sustain production levels, so you have to remember that free cash flow figure is incredibly hard-earned.
It's crucial we weigh these financial realities against each other impartially. The strengths? Undeniable. They have those low-decline assets, immense newly acquired scale, and a massive operating cash flow of $3.53 billion. But we've got to look at the weaknesses too. They operate with a very tight current ratio of 0.54, meaning their short-term liabilities heavily outweigh their liquid assets. If oil prices crash tomorrow, this lack of short-term liquidity could force them to lean heavily on debt facilities, which would rapidly erode shareholder value. Also, to achieve that immense scale, they literally doubled their share count from 600 million to over 1.2 billion shares. Expanding equity that aggressively to fund acquisitions introduces significant execution and integration risks that you've really got to monitor.
Section 3. Moats, risks, and cyclicality.
I absolutely love this metaphorical anchor from the source analysis. Think of Whitecap's operational business, their low-decline assets, and that infrastructure scale we talked about as a powerful, well-built engine. That engine gives them a moderate competitive moat against smaller players. But here's the problem. The weather they drive in is determined entirely by highly volatile, cyclical commodity prices. And Whitecap has absolutely zero pricing power over the globally traded oil and gas it produces. If the macro weather turns into a hurricane of plummeting oil prices, even the best engine in the world is going to struggle to move forward.
You can actually see this exact dynamic reflected directly in the analysts' quantitative scores. They've got a solid 7.0 out of 10 for both financial stability and opportunity. But look at that risk score sitting right at 5.4. That reflects the harsh reality of that macro weather. Whitecap's earnings are highly cyclical. When the weather is bad, profits compress rapidly. That 5.4 score bakes in the constant exposure to oil price collapses as well as the unique risks of operating in Canada. We're talking about the historic Western Canadian Select differential and specific pipeline bottlenecks that often force Canadian producers to sell their oil at a massive discount compared to global benchmarks.
Section 4. Calculating intrinsic valuation. Let's do the math.
The analysis uses multiple models to try and find a fair price for this company. In a bear case scenario, think oil downturns and multiple compression, the intrinsic value drops to $11.50. In a bull case, driven by energy scarcity and successful acquisition integration, value climbs all the way to $24.00. But the base case is where we really want to focus. By averaging a discounted cash flow model at $18.50 and a multiple earnings value model at $17.80, we arrive at a blended intrinsic value of 18.15 Canadian dollars per share. Blending these models is super important because it smooths out the variance between pure future cash flow projections and current market multiples, giving us a much more grounded, realistic baseline value.
Now, their standard forward PE of 9.95 is already quite low, but things get really interesting when you look at the PEGY ratio. This adjusts that valuation by factoring in Whitecap's robust 4.55% dividend yield alongside an estimated 9% normalized growth rate, giving us a PEGY of 0.73. A ratio below 1.0 is pretty rare for mature dividend-paying energy companies. This strongly signals that the broader market might be heavily mispricing the durability of Whitecap's 9% growth rate, which suggests the stock is currently undervalued relative to the actual income and growth it provides.
Section 5. Target prices and verdict. If your goal is to lock in a solid 9% annualized return, the math dictates very specific entry points depending on your time horizon, assuming those normalized valuations hold. Step 1, if you have a 5-year horizon, you need to buy in at $14.80. Step 2, for a 10-year horizon, your target drops to $13.70. And Step 3, if you're looking at a 16-year investment, you need an entry price of $13.00 flat. Why does the target entry price drop for longer horizons? Well, because the longer you hold an upstream producer, the more exposure you have to severe commodity down cycles. You demand a cheaper entry price up front to offset that compounded macro risk over time.
Summarizing all of this into a definitive entry and exit strategy, the data breaks down like this. Whitecap becomes a strong buy below $13. It's a hold in its current range between $14.50 and $18. If it pushes above 21, the math suggests you begin to trim your position. And anything above 24 warrants a full exit, unless the underlying fundamentals have materially improved. Impartially speaking, the data here suggests that a truly optimal low-risk entry into this stock typically only happens during recessionary oil price corrections, basically when the market is fearful.
And that brings us to our concluding verdict quote, directly from the source analysis. For long-term investors, the key question is not whether Whitecap can survive, but whether commodity prices remain supportive enough to sustain high free cash flow and shareholder returns over time. The company's survival isn't the issue. The durability of the cash flow is. This is fundamentally a cyclical value play that is heavily dependent on macro conditions. It is not a defensive, recession-proof core position.
Which leaves us with this final question to consider. With Whitecap currently trading around 15.68, it sits about 14% below that blended intrinsic value of 18.15. So, is a 14% margin of safety wide enough for you? Or do the cyclical realities of the global oil market demand a deeper discount before you decide to buy the engine? You'll have to weigh the macro risks against the deep value metrics for yourself. Thanks for joining me on The Explainer, and keep learning.